Simply Financial with Christopher Calandra, Certified Financial Planner, is an innovative, comprehensive, informative, and cutting-edge podcast that discusses financial topics ranging from personal finance, economics, politics, and personal growth. Simply Financial will cover intriguing and thought-provoking questions so that the listener can simply increase their financial IQ.
I'm your host, Christopher Calandra, for the Simply Financial podcast. We are in season number 2, and this is episode number 47. Welcome to this edition of the Simply Financial podcast. I have with me in studio Jeremy Hyatt, a mortgage professional. I had met Jeremy several months ago. We worked on a few things together. In fact, recently we hosted a little networking happy hour, and I wanted to talk to him about mortgages, some tips for people that are looking for mortgages, as well as talk a little bit about where the where the mortgage market is today with increasing interest rates and where the real estate market is. So thank you, Jeremy, for coming in and hanging out.
My pleasure. Appreciate the invite. It's glad to be here.
So did you always want to be in the mortgage business? I mean, did you grow up saying I'm going to be a mortgage professional?
No, not quite. I kind of fell into it, but it's been 13 and a half years, and it's been a great ride, and I'm happy where I am for sure.
What are some of the best parts of doing this for a business? It's a tough business in many ways,
it is.
like most are, and
yes.
So what do you like about it?
Well, I mean, like any profession, it has its ups and its downs, pluses and minuses. But I mean, the good pieces, I would say, are the unlimited income potential, the freedom. You're not necessarily locked into a 9 to 5 clock in, clock out.
So it's entrepreneurial.
It is. It definitely is. Prior to getting into this profession, I was more the clock in, clock out. Your time was basically the commodity that was limiting because you were getting paid per hour, what have you. This is a little bit more entrepreneurial and allows you to kind of build a business, so to speak. But I would say, honestly, the biggest piece for me is being able to help families and help people get into a good situation. And obviously, home ownership is the American dream. So, I mean, what's more fulfilling than that?
To be part of that.
Absolutely.
Pretty awesome.
It is.
Now, you mentioned the flexibility, being an entrepreneur, create your own hours, not 9 to 5, not punching a clock. You have a wife and a young family.
Yes.
Try and use that to your advantage. Good work-life balance.
Yeah, I mean, you try to. I mean, 2-year-old, 4.5-year-old, wife. So there's some obviously some obligations outside of the career. And to your point, I mean, the positives were what we just mentioned, but the other side of it is that you're always on call. I mean, you always have to be available. So that's a struggle at sometimes to be sitting there, bathing the kids and trying to get them ready for bed, and the text or the phone goes off, and it's one of your great realtor partners that's looking for whether it be some feedback on a scenario or a pre-approval letter. So you have to try to walk that line.
Beautiful. So let's get into it a bit. So if somebody's looking for a mortgage, educate us on what are some of the key metrics that lenders look at when they're considering somebody for a loan?
Great question. The short answer is income, assets, and credit. But in the mortgage space, in the banking space, in the lending space, there's always been what we call the 5 C's of lending. And the first one is credit history, which of course is the track record you've established while managing credit and making payments over time. That is, the history of your ability to repay. Now that is basically converted into a scoring model. I'm sure you heard the term FICO scores, right? Yeah. They range between 300 and 850, and of course, the higher end of that range is going to, fetch more favorable pricing.
Better.
Yes, the higher the better.
So that's the first C.
And then the next is capacity, which is basically your ability to handle or manage your debt load. So basically, it's considered to be your debt to income ratio, or DTI, as we use in the mortgage industry. So that's basically from a financing standpoint, a mortgage standpoint. We take a look at any obligation that shows up on a credit report, student loan, auto loan, credit card payment, and then add whatever if you're purchasing the new mortgage payment, including taxes, insurance, if there's any kind of PMI or private mortgage insurance, and we add those obligations up, and then we equate that to a percentage of your gross monthly income. And typically the standard is about 45% is going to be the maximum. And there are some programs that we can go higher, but that's generally speaking the capacity piece of it.
So we have the credit part, capacity. Yep. What's next?
Collateral, which is basically the property. Of course, whenever you're lending on a piece of property, you have to make sure that the value is there, that the property is in, a good position as far as the structural and mechanical and things like that. You can't be lending money on that are dilapidated unless you're doing, of course, a rehabilitation loan, and then we can
right. But that's kind of a specialized. But
Correct.
Generally speaking, they want a property that's in good condition, good working order. And does that also cover like the value? In other words, if I'm paying $300,000 for the house, it should appraise for it should be worth $300,000.
Absolutely. So whenever it comes to the appraisal piece of it, of course, that is the collateral. Through any lending transaction, whether it be a refinance or a purchase, you're of course going to have an evaluation of the property to make sure that, of course, the lender is protecting their investment in the property, but also to make sure that the potential buyer or refinancer is not getting themselves over the head.
That makes perfect sense. In today's day and age, like where the market is today, do a lot of deals fall apart because the collateral, in other words, the property's not appraised at a good enough price? Or is that something, I think years ago after the financial crisis there was some dislocations that seem to happen a lot. Is that kind of rare now or no?
You see it less in a rising home or an appreciating value type market. Whenever things were kind of going the other direction, you would see it potentially more often. I mean, don't get me wrong, we still see it. It's just not as prevalent as it was.
So in the last 6
back.
months, have there been dozens of those that you've seen with you or say in your office, or can I count them on one hand?
Yeah, one hand.
Okay.
One hand.
All right.
One hand.
And what's after collateral on the 5 C's?
Capital, which is basically your assets or reserves. So not all loan programs require a down payment. And there are some that, we could help not only with down payment, but also closing costs. But the more stable you look in the way of, from a risk standpoint, the better. So the larger the down payment, typically the better. Mm-hmm. The more, the term that we use in the lending industry is reserve. So let's say your payment is $2,000 a month, just throwing a number out there. If you have $10,000 left over after the transaction in assets or reserves, that calculates out to be 5 months of reserves. So the more reserves you have, the more stable it makes you look as a potential risk. Because if, let's say, something happened to your income source, then they could utilize that and say, okay, well, he has 5 months of the payment left over to potentially make if there was something to happen to his source of income. So
that makes good.
So that's the capital piece.
All right. And what's the last of the 5?
Conditions.
Is it the best?
Yeah,
Did you
no.
save the best for last?
No, I did not. No, it's basically conditions. And basically all that means is under what conditions is the lender offering the financing? Is it a purchase? Is it a cash out refinance? If it is a refinance to take money out of your property, what's it being used for? That kind of thing. So that encompasses the 5 C's.
So you've been at this a while. Is it fair to say that of the 5 C's that the credit score piece has become more important over time?
I would say that it's important, but I would say if I had to throw one or choose one, I would definitely say it would be the capacity or the income. Mm-hmm. So, I mean, the mortgage crash, the meltdown and what have you, I mean, that was all because, people were being put in a position where they couldn't effectively repay that obligation. Right. So I feel like that has become, more of the forefront of, they're all important, don't get me wrong.
But that's gotten more important over time.
Yes.
Like your credit history counts less, and your credit character, if you will, counts a little less, right, than income. Like, it seems to me that's become so much more important than it was before the financial crisis.
Yeah. Yes, definitely. I mean, I got 13 and a half years ago, going on 14 years ago, I actually got my start in the subprime mortgage industry. Where
lucky you.
If you had a pulse and the access to a pen, you were basically given a mortgage. So yes, to your point, credit history has definitely become more important.
All right. So if our listeners out there, let's say, are not in their first home yet and they want to prepare themselves, or another group might be somebody that's in her home but they want to get into their forever home or a dream home, they want to trade up, or even still others, somebody might want to buy a vacation home, what can they do to prepare themselves to become more lendable?
Honestly, my best suggestion would be to get in contact with a reputable mortgage professional early in the process, and kind of have them guide you and walk your hand through it. I mean, ultimately, it's going to be going back to those 5 C's. It's, making sure that you're making your monthly payments on your obligations on time. Mm-hmm. So they're not 30 days late. Of course, if you already are a homeowner, making sure that the mortgage payment doesn't go 30 days late. If you are planning on making a down payment, make sure that you have some assets aside and what have you. Things of that nature. So, I mean, just really going back to those 5 C's. But that's
good advice, though, because sometimes somebody, they say, all right, they get, let's say they're in a house and they get their house ready for sale, then they go out and find something, and then they say, well, let's check with the mortgage person. The mortgage person, whether it's you or another professional, they should get to you earlier so that you could work together as part of the process and not be under the gun, like, we found a house, we're ready to buy it,
right.
Let's go.
And
you could handle that, but that's not...
I do see that. I see a lot of times where people are kind of putting the cart before the horse, so to speak, where they're going out and they're looking at homes and they're, asking the realtor to take them, to look at 10 different places on a Saturday afternoon, but they haven't actually got their ducks in a row when it comes to getting pre-approved or even what they may be able to finance. So the bottom line is, get with a trusted mortgage advisor, earlier on in the process. And if for some reason you're not able to or you're not qualifiable or lendable at that point in time, a good mortgage professional will definitely kind of hold your hand and walk you through to the point where, okay, you need to do this, this, and this to be able to purchase 6 months down the road or what have you.
So early on in the process, I think, too, you want to, correct me if I'm wrong, you should check your credit.
Of course.
Because there's a lot of instances where there's errors on your credit report. And so your credit score could be artificially low.
Absolutely.
And fixing that is not a snap thing, right?
Correct.
So that's another reason to start earlier. And then also you could see where your metrics are early in the process, right? What you mentioned, what was it, DTC?
DTI, debt to income ratio.
That was close.
2
out of 3
letters.
Right. So then you could figure out, like with the mortgage professional, all right, if I pay off this debt, that'll help with my ratio and give me more room. What the target is for a down payment.
Correct.
And then if you save even a little bit more above that, you might get a better offer in terms of interest rate or some other
pricing options. Correct.
All right. Good. So how much of a better deal do you get with a better credit score? So the highest credit score is what, 820? You said
850. 850 is the highest. I've never
That's
seen
your
higher
credit
than
score,
825. Right? Oh, for years, of course.
Okay.
So the best.
So what's the difference? So are there categories in the...
They're tiered. So, I mean, it depends on the type of loan program. I'm sure you've heard of Fannie Mae and Freddie Mac, which are conventional financing terms, and then also FHA as well. So depending on the type of loan program, there's obviously other ones out there as well. From a conventional financing standpoint, they call them credit tiers or credit buckets. So 620 to 640, 640 to 660, 660 to 680, and so on.
Okay.
Until typically you get around the 740 range, and then typically anything above 740 or better puts you in the highest bucket, which of course will allow or afford for the best potential pricing because it's risk-based.
Sure. So if you have a higher credit score, that's an indication, not the only indication, but an indication that you're creditworthy and your risk is less.
Correct.
So you'll command a better deal because the issuer of the loan feels like it's a safer...
Correct.
All right.
The analogy that I've always used, Chris, is it's very similar to auto insurance. If you're driving a Ferrari and you had 2 speeding tickets, you're going to have a higher premium than if you drive,